So you're thinking about buying an Airbnb property, but you're not quite sure how to get a mortgage. Well, you're not alone. In today's video, I'm going to talk about the different loan types that you can use to buy an Airbnb property. And if a traditional loan type doesn't work, all the different types of what they call non-qualified mortgages work, like DSCR loans. So really the problem is that I see out there is that some people think that you can use Airbnb income to qualify for a mortgage right away. And some people think you can't buy an Airbnb property at all, using a mortgage. So the first thing to know is really how it works when you just want to use a conventional mortgage, the same type of mortgage you would use to buy a regular primary residence, and when those situations work. So if you have a regular W-2 job, typically, or you're self-employed, that's fine, and you can fully document all of your income and qualify, finance, or get a mortgage on an investment property, then that works fine. It's really not a problem. You cannot use projected income, though, on an Airbnb property for a conventional loan. And the reason is they don't allow that. So you cannot have a management contract in place and use projected income. You can't use Airbnb, what they would call rent rolls, where sometimes the seller will say, well, I can show you, a year's worth of Airbnb income. Well, you can't use that. You could only use that if it was claimed on a tax return and you were showing it on their Schedule E. And that's where you show your list of properties, investment properties that you own and rent out. And basically you pay taxes on it. And that would really only work in a refinance situation. So that works. Now, if you are going to get a conventional loan and you want to use projected income, then you can. Now, if you have owned a rental property in the past and you can show any year's tax return where you've claimed rental income, then you can use 100% of the projected income to qualify for the mortgage on the property that you're buying. So typically that would be, it would be from either a lease that's fully executed by the future tenant, and that lease would have to be for at least a year, and you would have to show at least 2 months of rental payments being made and deposited into your bank account. And then you could use 100% of that. Now that's again for somebody who can show a history of being or owning investment property and claiming it on their tax return. If you don't have a history of that, then you can use 75% of the projected lease. Again, you would have to have at least a 1-year lease with 2 months of payments in the bank. And then you could use 75% of that lease, but only to offset the principal and interest, the mortgage payment that you're qualifying for. So if it was a $1,000 mortgage payment, you had a $1,000 rental agreement in place with 2 months of rent in the bank, then you could use $750 of that to offset it. So you'd, in effect, only be qualifying in that scenario for a $250 a month in additional debt on your application. So that works for a conventional loan. Of course, if you already own your primary residence and you want to buy another home and turn your current home into a rental property, those exact same guidelines that I just explained go into place, and that's fine. You can make that an Airbnb property. You can do everything you want with it because you already own it. But really, the purpose of this video is for people that are looking to buy an Airbnb property. So in that case, yes, again, if you can fully qualify, you have plenty of income, that's no problem. Now, an investment property, whether you're buying using a conventional loan or a DSCR loan or a bank statement loan or any of these other loans we're going to talk about, it's going to take at least 20% down. There are some programs now where you can put 15% down, but of course that's going to be the highest interest rate there is, but it is possible. So let's say that this is something I come across a lot. Let's say that you're buying an Airbnb property, but you don't qualify. You don't make enough income for whatever reason to qualify for this new mortgage. A lot of times that's going to be because you are self-employed. I deal with a lot of self-employed buyers, and they make plenty of income. Perhaps you make plenty of income, but your tax returns don't reflect that because, of course, you take, the deductions that you are allowed to take to reduce your tax burden. Well, if that's the case, then you would use an alternative income type loan, or basically a no income type loan. And today what we're really talking about is DSCR loans. Of course, you could use a bank statement loan. That might be a slightly lower interest rate, but it's a lot more hoops to jump through. And honestly, sometimes the rates are even better, or at least the same, on a DSCR loan. So DSCR loan stands for Debt Service Coverage Ratio. And what that really means is you're not using any income on the application to qualify for this mortgage. All you need to do is have the property, what they call cash flow. So as long as the fair market rent on the property covers the mortgage payment you're getting, then that works. It's not a problem. You can put 20% down, maybe 15% down, and qualify for the loan. You don't have to show all of your income documentation. You only really are going to have to show where the money's coming from for the down payment. And honestly, a lot of times, since these are not considered retail investment or retail mortgages, they're business purpose mortgages, there are even programs where you don't have to show large deposits or prove where the deposits came from, which is, if you've done a mortgage in the last 10 years, that's always a big deal. You always have to show, where does this deposit come from? On a lot of these loans, they don't even ask you to source the money. So a lot of times I'll work with people and they're like, oh, I've got money in a safe at home, or my brother is going to give me some money. Well, it's not a problem. And that's what makes these loans a lot easier to do. Well, back to the Airbnb piece. What's really cool about a lot of these loans and a lot of the banks and investors I work with is not only do you not have to show any income, they will use something called an AirDNA score. So AirDNA is a website where you can go, it's really free to create an account and log in. You put in the address of whatever property you're thinking about buying, and it will show basically the projected rent that property can expect to get. And typically it'll say like it rents for whatever, $200 a night. It's expected to rent for 15 nights a month. So you just say 200 times 15, whatever that is. As long as the mortgage payment isn't over that amount, then it works. It's almost always higher than what the mortgage is going to be. So, that works out great. I've got several borrowers right now using that exact same program, which is perfect. Now, again, that's going to probably be, at least 20% down, probably 25% down. And honestly, on any of these DSCR alternative income documentation loans, or really for that matter, the conventional investment property loans, 25% is always going to be a big difference in rate than 20% down. I don't know exactly why that is, but it's definitely a thing. So anyway, now let's say, for example, and also to get back to that, let's say, for example, that the DSCR or Airbnb, AirDNA website score isn't enough to cover it. Well, they'll typically even go down to 0.75, which means, for example, that on a $1,000 mortgage payment, as long as the fair market rent, according to an AirDNA analysis, is $750, that would still work. Well, let's say, for example, even that doesn't work. Well, they also have there's a lot of acronyms I'm using, DSCR program, which again is debt service coverage ratio, where you're not using any income to qualify, it's called no ratio. So in other words, it doesn't matter at all what the rent is. They don't even use the rent. So you're not using any fair market rent. You're not using any income to qualify. As long as you've got the credit score and you have enough of a down payment, then that works. And that's typically going to be capped at about 75% loan to value. In other words, if you're buying $1 million property, the most loan you can get is $750,000, which is obviously typically enough. Just checking my notes, make sure I don't miss anything. Again, thanks for watching this video. If you found this helpful, it helps me a lot if you would click like and subscribe. If you have any comments, just put them in the comments section below. I think maybe some of my final advice is before you go under contract on a property, talk to a mortgage professional that understands all these things. Whether you're going to get a conventional loan or get a DSCR loan, you need to know what you're going to do, because a lot of times it's property dependent, right? You might also run up against a scenario where you want to buy a property, but it doesn't even meet conventional guidelines. In other words, it's something like what they call a condo that, let's say, for example, they're behind on their dues from borrowers. In other words, Fannie Mae wouldn't finance that. Well, that's something you could get with a DSCR loan or some other non-qualified mortgage like that. So anyway, if you found this helpful, again, click like and subscribe. Put any questions in the comment section below. Go to my website, mortgagesbyscott.com, or you can even send me a text. And I'm happy to help you qualify for a loan. I lend in quite a few states now: North Carolina, South Carolina, Florida, Georgia, New Hampshire, Virginia. So anyway, thanks for watching.